Government policies play a critical role in shaping the value of cryptocurrencies, as they directly influence investor sentiment, regulatory frameworks, and the overall market environment. These policies can either foster a conducive environment for growth or create obstacles that lead to market volatility and uncertainty. The impact of government actions on the crypto market is complex, as different governments have varied approaches towards digital currencies, ranging from outright bans to regulatory frameworks that aim to integrate cryptocurrencies into traditional financial systems. The effect of these policies is often reflected in the price movements of cryptocurrencies, which can rise or fall dramatically based on the perceived level of support or restriction from governmental authorities. One of the most significant ways that government policies affect cryptocurrency prices is through regulation. When a government decides to regulate cryptocurrencies, it is usually done with the intent to prevent illegal activities such as money laundering, terrorism financing, and tax evasion. However, the manner in which these regulations are implemented can have a profound effect on the market. In countries where governments create clear and transparent rules for crypto exchanges, initial coin offerings, ICOs, and cryptocurrency transactions, the market often reacts positively, as such regulations provide legitimacy and reduce uncertainty. For instance, in countries like Japan and Switzerland, where regulations around cryptocurrencies are well established, the market has generally seen steady growth as institutional investors feel more comfortable entering these regulated environments. This regulatory certainty can lead to a more stable and predictable market, which is often conducive to higher prices. On the other hand, government policies that impose restrictive measures or outright bans on cryptocurrencies tend to have an adverse effect on the market. When a government announces such measures, the price of cryptocurrencies often experiences significant declines, as investors fear that these actions will limit the use and adoption of digital currencies. For example, when China cracked down on cryptocurrency mining and trading in 2021, Bitcoin and other cryptocurrencies experienced a sharp price drop. China's strict policies led to a massive exodus of miners from the country, which disrupted the Bitcoin network and affected its price. Similarly, countries like India have at times considered introducing stringent laws that would severely limit cryptocurrency trading, causing uncertainty and volatility in the market. These government interventions often result in a loss of investor confidence, leading to sell-offs and declines in price. Government taxation policies also have a substantial influence on cryptocurrency prices. In jurisdictions where cryptocurrency is treated as taxable income or subject to capital gains tax, investors may be less inclined to hold or trade digital currencies. Tax policies can influence investor behavior by altering the cost-benefit analysis of trading cryptocurrencies. For example, if governments impose high capital gains taxes on cryptocurrency profits, it can reduce the attractiveness of digital currencies as an investment. This could lead to lower trading volumes, a decrease in demand, and subsequently a drop in prices. Conversely, in countries where crypto-friendly tax policies are in place, such as Portugal or Germany, where crypto profits are not taxed or are taxed at lower rates, the crypto market often sees more activity and higher demand, which can drive prices upward. Another aspect of government influence on cryptocurrency prices is the relationship between government-issued currencies, fiat currencies, and digital currencies. Central banks around the world have the authority to control monetary policy, and their actions can indirectly affect the value of cryptocurrencies. For example, when central banks engage in practices like quantitative easing, where they inject more money into the economy, it can lead to inflation, eroding the value of fiat currencies. In such cases, cryptocurrencies like Bitcoin, which are often viewed as a store of value, may become more attractive as an alternative investment. As more people seek to hedge against inflation and preserve their wealth, demand for cryptocurrencies can rise, leading to price increases. In contrast, if central banks tighten monetary policy by raising interest rates or reducing the money supply, the demand for speculative assets like cryptocurrencies may decrease, causing prices to fall. The stance of governments on the use of cryptocurrencies for payments and adoption in the broader economy is also a key factor in determining their price. When governments take steps to integrate cryptocurrencies into the financial system, such as by allowing businesses to accept them as payment or creating legal frameworks that recognize digital currencies, the market often responds positively. For example, El Salvador made headlines in 2021 when it became the first country to adopt Bitcoin as legal tender, and the market saw a short-term price surge as a result. In contrast, governments that restrict the use of cryptocurrencies for payments or prevent businesses from accepting them can dampen demand and negatively impact prices. For instance, when countries like India or Russia discuss banning cryptocurrencies, market sentiment tends to turn bearish, leading to price drops. Furthermore, government policies surrounding the issuance of central bank digital currencies, CBDCs, are an emerging factor that could impact the price of cryptocurrencies. Many governments are exploring or developing their own digital currencies, which are state-backed and typically operate on centralized systems. The introduction of CBDCs could create competition for decentralized cryptocurrencies, particularly in terms of mainstream adoption and use in payments. If CBDCs gain widespread acceptance, they could undermine the demand for decentralized cryptocurrencies, resulting in downward pressure on prices. On the other hand, the development of CBDCs may also contribute to greater mainstream acceptance of digital currencies as a whole, which could, in turn, benefit cryptocurrencies by increasing overall market awareness and adoption. Public statements by government officials and policymakers can also have an immediate and profound impact on the crypto market. For instance, when high-profile politicians or financial regulators comment on cryptocurrencies, the market often reacts strongly. Positive comments from influential figures, such as endorsing the use of blockchain technology or supporting the innovation potential of digital currencies, can lead to increased market optimism, boosting prices. Conversely, negative comments or warnings about the risks of cryptocurrencies can lead to price declines. In particular, regulators in the United States, such as the Securities and Exchange Commission, SEC, have a significant impact on market sentiment. The SEC's stance on issues such as whether certain cryptocurrencies are classified as securities can create uncertainty, which can directly affect the price of those assets. In addition to regulatory policies, governments also influence cryptocurrency prices through their stance on anti-money laundering, AML, and Know Your Customer, KYC regulations. These regulations require cryptocurrency exchanges to verify the identities of their users and report suspicious activities. While these regulations